More news coming in. Tactical Operations Unit in NSW, Australia have arrested 5 men of Middle Eastern appearance after ramming into a vehicle, shooting beanbags in a top-secret operation that has not been confirmed to be linked to the recent Bondi events. However, it has been reported that the men that have been arrested did have firearms in the vehicle, not yet confirmed. This information is coming in from New South Wales on your screens at this point in time. There is another scare that has now been reported in Australia. We're telling you about it. Well, there were Middle Eastern men, or at least in appearance. Well, they rammed into a vehicle, shooting beanbags in a top-secret operation that has not been confirmed to be linked, though, to the recent Bondi events. It's been reported that the men that have been arrested did have firearms in the vehicle and not yet confirmed. This is a tactical operation that is being seen right now and that we are reporting on, as heavily armed tactical police swooped on a group of men believed to have been on their way, in fact, to the Bondi beach, is what we are learning. Some sketchy information at this point in time, but Pranay has more. Pranay, what happened here? Any connection whatsoever to the Bondi attack that took place? Who are these 5 suspects? What more can you tell us?
Australian police, both RCO as well as the Australian Federal Police and New South Wales Police are investigating this entire Bondi Beach case. They have picked up 5 people. This is what we are learning from our sources and the local media reports as well. And they were believed to be traveling to Bondi Beach. However, Bondi Beach is now being cleared. The crime scene restrictions have been lifted by the New South Wales Police. But the case is still on. They are investigating. They are looking at all the antecedents of the 2 individuals, those who are involved in that Bondi Beach attack. And now they have picked up 5 people. They will be questioned. There are investigations which is on. And in fact, we know that the external links to this case are also being investigated. The Australian federal authorities have sought help from various other governments as well to find out the links to this Bondi Beach terror attack.
All right, I'm going to leave it at that for the moment. Pranay Upadhyay getting in those details. My colleague from India Today Global putting that into perspective. All right, let's now go straight across to my colleague Sakshi Batra, Business Today Television, with all the updates of the markets. Over to you, Sakshi.
Good afternoon and welcome to the market closing on our collab show between Business Today and India Today Television. This is the 3 p.m. show where we get you all the market closing action. But first up, let's take a look at what's hot in the corporate and the financial world. Shares of asset management companies skyrocket after SEBI changes mutual fund fee structure. Reports say the average transaction cost for fund managers could drop by as much as 15 basis points. The Nifty also rebounds after initial drop, even as Asian markets close deep into the red. Shocking reality for investors. The share of India in global market cap now falls to a 29-month low despite the Nifty rising more than 8% this year. This is a result of sustained foreign investor outflows. The BSE market cap has now slipped to $5.19 trillion as of yesterday, 9% down from the all-time high of $5.66 trillion in September last year. Indigo CEO responds to employee backlash in face of the flight chaos earlier this month. In an internal video message, Peter Albers urges all to avoid engaging in speculation. Says the senior management will travel across the network for feedback, assures a full analysis of the disruption by an external expert. Tamil Nadu Chief Minister M.K. Stalin now writes to Prime Minister, says US tariffs have destroyed the textiles industry in Tirupur. Also claims that confirmed orders worth 15,000 crore rupees have been lost. The state finance minister also tells India Today that proposals to raise state share in various welfare schemes will hit its economy, which grew at an astounding 16% in FY25. Tata Group reportedly has set to infuse another 1,500 crore rupees into the Tata Electronics company to ramp up its iPhone manufacturing capacity, taking the total investment this year to 4,500 crore rupees. The funding will also support expansion and key semiconductor projects, including new fabrication and assembly units in Gujarat and Assam. Good afternoon to everybody. Let's quickly look at how the markets are trading at this point in time. We are hovering above the 25,800 odd mark. The sectors that are still up and about are IT, the real estate sector, the mid and the small caps, metals and PSU banks. But there is some pressure building up among the other sectors. The private banks have now slipped to the low point. They have slipped into the red. The Nifty bank has also slipped into the red right now with a lot of choppiness that's coming in. FMCG and Pharma sectors have also lost some ground. On the Nifty, however, you have names like Indigo that are back in action. You can see about 2.7% of an uptick on Indigo shares today. 5,117 is the new level. TCS, Tech Mahindra from the IT pack, Infosys, Wipro also among the top gainers as far as the Nifty is concerned. Let's actually now welcome our guest on board. Siddhartha Khemka, the Head of Research Wealth Management at Motilal Oswal Financial Services, is with us. Warm welcome to you, Sid. Good to have you with us after a long haul. Do help us understand, as we are inching closer to the year end, what is it that you are gauging about the market sentiment right now, even as we look forward to the new year? Will there be enough opportunities for investors to make money in stock markets?
Hi, good afternoon, Sakshi. Glad to be on the show. I think 2025 was a year of consolidation, not only from the markets, but also from the earnings perspective. After COVID, we saw 2 to 3 years of very strong corporate earnings growth. And last 1.5 years, we have seen that corporate earnings growing at single digit, mid-single digit, and that has led to some consolidation in the market. However, going forward, we believe that the corporate earnings growth recovery should happen, led by several factors at play. There has been a lot of policy support, both from the central bank, which is the RBI, as well as the central government. We have the policy support in terms of the GST rate cut, the interest rate cut coming in, and a lot of liquidity pushed by RBI. The festive season demand that is likely to recover, push some demand recovery. And going forward, we believe that after a year of consolidation, again, think the valuation has now cooled off, especially if you see in the large cap space, which is down somewhere about 21 times on a 1 year forward basis, compared to about 24 times on a PE multiple 1 year back. So we expect there should be a lot of room for growth, as well as for the market to recover in 2026, and we expect about 10-15% kind of return. One should not build in a huge return expectation from market going till the time we don't see that earnings recovery that starts taking shape.
Fair point, but 10 to 15% could be anticipated as the new year is concerned, as far as returns on stock markets are concerned. Stay on with us. Sid, we are also joined by Mr. Harshvardhan Roongta, and we are going to be really panning out our discussion deeper as far as the mutual fund space is concerned. Warm welcome to you, Mr. Roongta. Good to have you with us as always. The SEBI has now announced some major decisions after its board meeting yesterday. It was a broad market reset, from mutual fund fee to stockbroker rules to how IPO shares are locked in and disclosed to investors as well. The regulator has slashed and unbundled the mutual fund expenses, overhauled 3 decades-old stockbroker regulations, and pushed brokers to show every cost and compliant trail to clients as well. The IPO norms have also been aced with a tech-backed system to mark pledged pre-issue shares as locked in, making life easier for promoters while tightening the guardrails for public investors as well. A revamped investor charter for brokers now forces clearer rights, timelines, and a stronger grievance redressal system as well across scores and online dispute resolution. And for more on this, we want to just gauge one by one what exactly has happened and how will the end investor at large be impacted with all these newer norms that are coming in. Let's start off with the mutual funds, because a larger audience of India today have started to invest in mutual funds in a big way. We have seen the SIP flows all month on month increase to record high levels. So the focus is there. On the mutual fund, the expense ratio, that's the fee that we pay to AMCs to manage our money on an annual basis, has been changed, unbundled, reduced. The big question is, are mutual fund investments getting cheaper for investors like you and I?
Well, hi, good afternoon, Sakshi. Good to be on the show always. Well, very quickly, let's understand the intent of SEBI as a regulator. Well, so to begin with, the intent of the regulator has been very clear to make the markets more efficient, to make the processes more transparent, and to give the economies of scale, the benefit of economies of scale to the investor, to the end investor. As you rightly pointed out, that SIP numbers have been going up regularly, and we are at about 29,000 crores per month. That's the SIP numbers. The total asset under management has also gone beyond 80 lakh crores. So I think there was definitely a time that the benefit of economies of scale would be passed on to investors. Accordingly, as you rightly mentioned, there has been an unbundling of the charges. So let me just explain very briefly what was the situation earlier. So if I as an investor was given a number, which was termed as total expense ratio. So this was a total expense that I would pay to the fund house as an investor for managing my money. Now the fund house internally would break that internally in the fund management charges, towards the brokerage fees, towards stamp duties, GST. All that put together was bundled and termed as total expense ratio. That is what an investor would be paying to the fund house. Now what SEBI has done is they have unbundled it to that extent to say that there will be a base expense ratio. So this is going to be the fund management charge. All the statutory expenses are beyond that, such as the GST, such as the securities transaction tax, such as stamp duty, etc., will be in addition on actuals. So very clearly, the unbundled.
Help me understand, Mr. Harshvardhan, that when it comes to the average investor, how does one understand what is the kind of differential that they will have to probably enjoy now with this reduction coming in? Of course, unbundling is one thing, but you still have to pay taxes in some other fashion. But when it comes to the entire expense ratio, how much of the cost gets reduced for me if I invest via mutual funds? What is the aspect there?
Okay, so the first part, as I said, was just unbundling the total expense ratio into a base expense ratio plus the actual statutory expenses. Now, on the other hand, there have been certain reduction in the expense ratio by itself.
Correct.
For example, the mutual funds were entitled to charge a maximum expense ratio of say 1% for index funds. Now that has been reduced to 90 basis points. So that maximum that a fund house can charge you has also been rationalized downwards and reduced by about 10 basis points. So that's one cost that you will see that there would be a reduction. Though I may say that most of the fund houses were not touching the maximum limit in any case. That was the maximum you were entitled to charge. Does not mean that they were charging that much, but that maximum has also been reduced by about 10 basis points. Now,
there is a cap, so to speak, now. That 0.9%, you cannot charge more than that as a mutual fund company.
That's correct. So invariably, however, I just want to reiterate, however, most of the fund houses were not charging 0.9 in any case or 1% in any case. Just that limit has now still been reduced. The maximum that you're entitled to charge has also come down. Though invariably, most of the index funds would be charging between 30 to 40 basis points. So, however, there is some rationalization over there happening as well. The other area, there was a temporary charge of 5 basis points that every scheme was entitled to charge if they were leaving exit loads. So now that has been completely done away with. So there's again a marginal cost saving that you will have. Now, within internal points that I would want to highlight, there is a cap on what the fund houses pay towards brokerage for transacting. So earlier there was if you had to buy and sell shares in the cash market, that's what mutual funds do, right? Eventually, there was a cap of 12 basis points. Now that has been reduced to 6 basis points. If you're dealing in FNO, the futures and options market, then the cap was 5 basis points earlier, which has been reduced to 2 basis points now. So I think all these cost reduction measures that have been incorporated, some may be applicable immediately, some will take some time to pan out. Overall, the intent has been to reduce the cost of investing for investors so that the efficiencies come in and investors experience higher return, at least to that same context in which the expenses have come down.
I know. Mr. Harshvardhan Roongta, I wanted to understand, I know this will be a difficult question because we don't have a clear answer as to how much will each AMC charge now that the revised capping of the charges have come in. But for any average investor who does, say, a 10,000 rupee SIP, over the next 10 years, 20 years, 30 years odd or so, what is the kind of broad range of savings that they can do on these charges now?
Well, as you said, it's a bit difficult to quantify the numbers, but I would say that you can expect a reduction in the cost to the extent of approximately 10%. So if you were paying a total expense over a period of time for, say, about a 1 lakh of rupees was your total expense that you were paying, that you could expect it to come down by 10% to 90,000 now. And, I think anyone would make a guess that after a couple of years again, when the market expands further, more investors come into picture, the benefits of economies of scale will be further passed on. So I think this is one of the measures in the right direction, clearly making sure that the investors stand to gain from reduced cost so that it directly commensurates into higher returns for them.
Much, Mr. Roongta, for speaking to us and for detailing for all our viewers what these new changes really mean for mutual fund investors at large. Many thanks for being with us on the show. Let me go back to Siddhartha Khemka. And Siddhartha, I want to understand, with respect to the AMCs at large, we've actually seen all the AMC stocks rally in trade today, anywhere up to 6 to 8 odd percent. Now, there was a big fear that, okay, if their earning is getting reduced, they should have actually fallen in trade. But the big expectation is that earlier, as per the proposal that SEBI had given back in October, it would have been further pressurized on the AMCs, but final reduction has been lower than the expectation, and that's why they are probably enjoying this at this point in time. How do you see the AMC business at large for all these companies who may be having a lesser earning because of this expense ratio reduction? How would you see this business, and what would you do with all these companies, HDFC, MC, UTI, Nippon Life, all of these companies that are listed?
Sure. I think, Sakshi, you have to look at it from two perspectives. A is that the long-term structural story, which is the financialization of Indian savings, Indian household savings, that continues to be the key structural driver for the wealth management companies, asset management companies, some of the investment advisory companies. I think that would continue to grow over the next few years. In the interim, there are a lot of calculations that are going on as to with regards to what the actual cost is and what the current capping that is bringing on. So our internal calculation suggests that bulk of the AMCs are closer to what the new regulations are. So it will bring down maybe the cost of the brokerage by about 1 to 2 basis points in the cash segment. In the derivative segment, more or less, I think our discussion suggests that AMCs are within that 2 basis points cost that they are giving to. Anyways, for the mutual fund companies, specifically which these regulations are for, there is a very small exposure in the derivative segment. So overall, we believe that yes, the market was fearing even worse of about 2 to 3 basis points in the cash segment. That could have really impacted the profitability of some of the asset management companies. With the 6% capping on the cash brokerage, and this excludes the statutory expenses. In the earlier 12 basis points, the statutory expenses were included. So essentially, if you remove the statutory expenses, the 12 becomes 8.5, and 8.5 has now been reduced to 6. So we remain very positive on the asset management companies, the HDFC, AMC, Nippon, as well as Nuvama Wealth Management. So all these companies are some of our preferred picks in the as an AMC space.
Okay, look at the brokerage houses now that are listed on the stock markets as well. They also clearly reflect the momentum in the stock markets, the belief of the investors in the stock markets and the rising funds that we are getting here and the financialization of savings that we are seeing here. 3-decade-old stockbroker regulations have also been revamped, and SEBI has now pushed brokers to show every cost and compliant trail to clients now to be more transparent. How would you see brokerages in that aspect?
First of all, disclaimer that we are representing the brokers, so we have a definitely biased view. But what my belief is that in the past we have seen several regulations, not only in the broking industry but in the asset management So all those things have only strengthened the market. The more transparent the system becomes, I think that creates the confidence, trust of the investors, and makes them more confident of coming into the industry, investing their money. So I think this is a step in the right direction, and that will only help strengthen the capital market industry and build in from here on. If you look at the penetration of demat accounts, the mutual funds, compared to some of the developed markets, developed economies, there is a long runway ahead for us going ahead.
Okay, fair point. So viewers, I hope that you've really understood as far as what SEBI's aim has been to create more transparency when it comes to your hard-earned money that's getting invested in the stock markets, either way by way of direct stocks or via mutual funds. The rules are now getting more transparent. You will clearly get to know what you are paying to who, exactly where, what kind of taxation do you have to incur, what kind of money are you giving to the fund houses as well, and for brokerage houses also, how does it change the life as well going forward from here. So I hope this has given you some clarity as to what has taken place as far as SEBI's decisions of last night are concerned. Let's move forward and try and understand as to what's the latest buzz on the stock markets today. It's Indigo that's the top mover on the stock exchanges. In fact, it's 2.6% higher on the Nifty, 5112 kind of levels that actually can be seen here. In fact, in a statement involving some straight talk along with with an olive branch for employees, the Indigo CEO has now asked the airline staff to not engage in speculation over recent flight chaos. In an internal video message to employees, the CEO, Peter Albers, has now addressed the recent letters and statements against the leadership posted on social media handles and has urged employees to stay calm, focused on their professional responsibilities and avoid engaging in speculations. He's also promised an impartial probe into reasons for disruption, and he said that he, along with other leadership, will be traveling across the airline network to understand the challenges on ground as well. Let's first see what he had to say.
We are finding our wings again. The worst is behind us. These last 2 weeks have been very challenging for all of us. As Indigo employees, we stood tall and united. Root cause analysis. What we witnessed seems a compounding effect of several factors. Everyone wants answers. Speculations are circulating, but I encourage everyone, please stay calm, focus on your professional responsibilities and avoid engaging in such speculations. We need a full-scale analysis first. An external aviation expert has been appointed by the board to conduct a comprehensive root cause analysis. Next to the root cause analysis, the leadership team, including myself, will travel across the network to meet you, understand the challenges you faced during this difficult time, and seek your feedback. A combination of this root cause analysis and your input will help us building Indigo even stronger and even better.
Siddharth, how are you viewing Indigo now that most of the challenges seem to be getting settled, operations on ground also seeming to be stabilizing at this point in time? There have been indications already over the last entire week from Indigo management that they are sorting out all the issues on ground and they will soon get back to their previous on-time performance and what Indigo is truly known for. Today, the stock is up by 2.7%, 5,100 back on the charts. How are you looking at Indigo? Is the worst behind? And should one again start to look at Indigo as a story to look at for the core portfolios?
So Sakshi, I think the core issue of the flight disruption, I think that could be behind, but the impact of the same would come in the Q3 numbers. And even over and above that, the government has mandated some of the penalties and fines on Indigo, plus they have curtailed around 10% of capacity in the current season. So I think all of this could be a pain in the near term, and hence I think investors who are holding Indigo can continue to hold from a long-term perspective. I think fresh entry should be avoided, and we should wait for the Q3 results and see more clarity as to how the regulatory overhang from here on could come up. Having said that, again, from a long-term perspective, they remain a market leader in the domestic market. So Indian aviation industry continues to grow. Government has facilitated a lot of tier 2, tier 3 airports, and I think that is where the continuous fleet addition for Indigo, both on the domestic as well as international circuits, could lead to growth in the longer term. But nonetheless, in the near term, I think one should have to wait for the Q3 results to make a concrete view.
Okay, got that. So that's the overview on Indigo. Stay tuned with us, Sid. We also have to cater to another important news, and that's coming in from Tamil Nadu. Tamil Nadu has actually stolen a big lead over the other states by clocking a massive 16% economic growth in FY25. In an exclusive conversation with Anaga Keshav, the state finance minister, he cited a focus on manufacturing and fiscal management for the tremendous numbers. He also, however, has warned that the lowering of the centre's contribution in various schemes could definitely hit states hard. Let's listen into what he had to say.
I would say that this should be attributed to the total economic policy of the government, which the government of Tamil Nadu has adopted. Our policies with respect to our investments and our sustained growth in various other sectors. The sector-wise policies which we have brought in, like for manufacturing, for constructions, for service. So every sector has contributed to this growth. And I would say that this is because of the concerted, clear-cut policies of the government, which has actually resulted in this. I would also attribute one of the reasons to the fiscal management of the government. The entire fiscal management is done in such a way that we have now ensured that this growth is made possible.
Could you give us some numbers regarding the fiscal deficit that you just mentioned?
Yeah, we have mentioned, if you take our the fiscal deficit, we have now maintained it at the 3% level when compared with GSTP. And the debt to GSTP ratio is also well contained within the prescribed limits given by the Finance Commission. That's about 26% last year. Now it is 27%. So that is well below the prescribed limits given by the Finance Commission.
So at a time when the Tamil Nadu state is performing so well when it comes to finances, the GSDP growth, do you think imposing more burden on the state through means of the new Mandrega fund shift, the 60-40 ratio, do you think this in some way harms the state's exchequer?
Yeah, definitely it will have a bearing on your exchequer because the more amount of fund needs to flow from the state government's exchequer to the schemes, which again means there is a tremendous financial stress on the state government. So that is what we have been consistently saying on the floor of assembly, in the media every time, that the state share towards the centrally sponsored schemes is now increasing. So the union government's share is gradually now being reduced, which is again now telling on the finance of the state governments. So that we still feel the stitch, but nevertheless we are not compromising on any welfare scheme. The state government is now augmenting our own resources to match this deficit.
All right, viewers, we'll now start to wrap up the markets. It's already 3:30. You can see 25,815. That's where we've shut shop 3 points lower in trade. So we have yet again ended lower. Remember, it's the Sensex contracts expiry today. And we have ended lower on the Nifty Bank. And even when it comes to the Sensex as well, down by 0.1%. Although the mid-cap index managed a 0.28% of an uptick in a weak trade, in a very choppy trade today. The advances to declines ratio still towards the positives as far as the gains are concerned. Some of the stocks that really rallied in trade today are Gabriel India, about 11.5% up in trade. Misho managed about an 8% of an uptick today. Remember, it did slip after those 7 sessions of a move, but again managed some gains. Motilal Oswal is up, IIFL Capital is up in trade. You do see a lot of these moves that are seeing on the positive side at this point in time. Indigo, we already marked out for you, is the top gainer on the Nifty right here. When we also look at some of the other gainers, Tata Consumer Products, Max Healthcare, Tech Mahindra, Infosys, large part of these IT names, 1.5% up. In fact, IT sector is the sector that has rallied the most in trade today. Real estate followed. We also saw mid and small caps, the small caps and the mid cap stocks that have been managed to pull themselves up today. Metals were shining bright. PSU banks also saw gains, but media stocks fell in trade. Auto stocks fell in trade. You saw infrastructure, oil and gas, all of these stocks, sectors coming under some pressure. On the downside on the Nifty today, you have Pharma as the top laggard today. Tata Steel, Power Grid, Asian Paints, NTPC, these were the top laggards right here. But we also have some news flow coming in, so let's quickly address that. This case is regarding Samman Capital. There is a clarification that's coming in. The case is in the Supreme Court based on an appeal against the earlier order by Delhi High Court, which in February dismissed a plea by Prashant Bhushan's Citizen Whistleblower Forum. The plea has claimed there were several irregularities in lending practices of Sammaan Capital involving loan to 5 borrower group companies and alleged quid pro quo between the 5 borrower groups and erstwhile promoter. The big news flow that is coming is that FIR launch has been seen against Sammaan Capital. Keep that in mind as well. But last couple of minutes, let's quickly go back to Siddharth. Siddharth, we have a few questions from our viewers. So let's quickly take that. Ram Singh from Ayodhya says, on AMC stocks, what kind of an opportunity can he scout at this point in time?
Management companies, some of the asset management companies are looking at, so we are looking at anywhere between 15 to 20% earnings growth over the next 2 years. So stocks like HDFC, AMC, Aditya Birla Asset Management Company, Nippon AMC and Nuvama Wealth. I think these are 3-4 stock ideas that one can look at in the current market. I think the regulatory overhang is now done with, and going forward a steady growth can be expected in some of these names.
Right, we'll have to cut short right here. Thank you so much, Siddharth, for being with us on the show. And with that, it's a wrap on the Business Today show. But stay tuned. India. Mr. Shivraj Singh Chauhan speaking right now.
All right, we'll go straight across to that press briefing that is being held by...